Good morning, everybody. Happy Friday, and welcome to Beat the Bell, presented by Kane Capital. FOMC week did not disappoint. Tons of volatility in the market, tons of trading, and tons of things to talk about. To do that, we've got an awesome panel with us this morning, starting with Money Mander. Money Mander, good morning.
Happy Friday. Good morning. Let's end the week strong here.
Absolutely. All right, Diamond Trades.
I'm sorry, I'm muted. What's going on, guys? Happy Friday. Like Alejandro said, wild week. Let's get after it.
All right, Ramsay Rippers. No intro necessary.
No intro necessary. Let's do it.
Catch him off guard.
A little bit off guard, but we're
Ryan's got a little bit of an out for Ramsay. I've noticed he catches him when he's lacking. All right,
it's ridiculous.
Snipes.
Good morning. Let's get some bags today.
All right, straight into Fed forecast, economic calendar. What do we got?
Let's go ahead and start with the economic calendar for today. So we have got durable goods, which comes out today at 8:30, and then we've also got the flash PMI composite coming out at 10 o'clock. That flash number at 10 o'clock can give a little bit of volatility in the market. That's something that I used to put off as news. But just be careful if you're going to be day trading around that time. You can get some volatility in the market. Not always, but sometimes. Obviously, the story of the week this week was FOMC on Wednesday. So let's dive right into it. So the FOMC raised rates by 25 basis points as the market was anticipating. The market had priced in, basically an 80% chance that they raised by 25 basis points, which is exactly what we got. So that brings the federal funds target range to 4.75% to 5%, which is more or less where the Fed projected we would be just 3 months ago, right? We had Powell mention that the committee had discussed the possibility of foregoing an increase at this meeting due to the recent turmoil in the banking sector, but decided that the financial system was stable enough to handle at least one more hike and possibly another in the May meeting, right? So some people came into this meeting with the mindset that because of turmoil in the financial sector, because of the SVB collapse, because of banks like Credit Suisse, really starting to worry people, right? Really starting to show some stress on the financial system, that the Fed would come in and they would not raise rates at all, just to maintain that sort of financial stability in the financial sector. But realistically, the Fed believes that tackling inflation is going to be equally, if not more important. And so they sort of said, look, we're going to do what we can to help the banking sector. And they also said that we're willing to step in and do more if necessary. That said, we still have to get inflation under control. We're still fighting this battle to get inflation down to our 2% target. And so we're going to continue raising rates as necessary as long as inflation remains sticky. And so the market was a bit choppy as investors tried to decipher what exactly the Fed was saying here. Are they really telegraphing a pause, right? Are they saying that they're not going to raise rates at this May meeting? Obviously, data dependent, depending what we get in April. Or are they saying that they are going to continue to raise rates throughout the rest of this year, which is what, I personally believe that they'll do. They'll probably raise at least one more time and then sort of sit there and let the cumulative effect of all of this tightening policy come in. But that's more or less where the Fed left us. And you can see that the markets are sort of wrestling with exactly, here we go. The markets are sort of wrestling with what Jerome Powell gave them. You can look at it under two lights, right? You can look at it again under the light that we're closer to the end, right? And so it's time to put on some risk. Or you can look at it through the lens of we're at the beginning of a very, very serious problem, which obviously would not be bullish for stocks. Mander, what did you take from the FOMC meeting this Wednesday?
Yeah, really exactly what you just said. And I think we're starting to see that in price action, right? This week's had crazy price action, a lot of confusion. I think that's because the Fed themselves are kind of confused right now. And so Powell did open the door to saying no more hikes may be necessary, right? He did put the pause on the table. But the way he framed it, if you listen to the press conference, it really was that if they don't need a hike, it's pretty much because something systemic broke and lending conditions and financial conditions are tightening themselves. And so the way he kind of framed it, he said, we're still resolute in getting inflation down. it's either going to be we have to continue hiking one time or two more times to get it there, or basically, after the bank run we saw and the financial illiquidity, he said there's the potential that inflation comes down on its own from where we've hiked to, but it's really because financial conditions and lending conditions are going to tighten extremely on their own because of a potential break in the financial system. What I really wanted to cover, though, today was the projections that we got. So we got our first projections from the Fed since really the December meeting. And yet again, we're in this position where Fed fund futures are calling absolute BS on the Fed here. And so as of the close of yesterday, Fed fund futures were pricing in a 99.5% chance of a pivot by the end of the year. Not even a pause, a pivot by the end of the year, 99.5. And this is immediately just after the Fed came out with their projections that still had the year-end midpoint for the target rate of the Fed funds interest rates at 5.1%. So basically, 17 of the 18 voting members just projected at the meeting that they're going to end it pretty much between 500 and 525, which would be another 25 basis point hike, and then a continued pause there for the rest of the year with no pivot. And then the markets come out and they're pricing in just a 0.5% chance that we even end where we're at, let alone another hike. There's only a 0.5% chance that we end the year here without a pivot. And so on the same note, there's 66% chance of a pause going into the next meeting, which I think is important. 50% probability that they hold there in June, and then another 50% probability of that pivot and that cut coming in July. And so to me, as I kind of looked at that, there's two scenarios going on here. Either the markets are just underpricing policy projections again, like we saw back in February, and then they come out and hike and we don't get this dovish thing that everyone's hoping for, and that kind of landslides us and yields will go back up. Or we get a legitimate systemic break here that forces the Fed to pivot prematurely with inflation still triple their target rate. And so to me, neither really sounds too appetizing there, but I wanted to see how you were taking that.
I told you the other day when we talked about this, I think this is different from February because, yeah, you're right that the markets are calling BS on the Fed, but I think that they now at least have like a legitimate reason to do so. I think that from late last year to early this year, all you heard was the Fed's going to break something, the Fed's going to break something, but everyone was kind of talking out of their ass because nobody had any clue what was going to break. And I think that now that we have evidence that there is actual strain on the financial system and where the damage is likely to occur, people can sort of see the end game from here, right? It's like, okay, if this instability in the financial sector continues, that is what's going to be the catalyst. That's going to be the end game for the Fed ultimately to pause, cut, and say, oh, we went a little bit too aggressive. Things are falling apart. Let's run to the rescue and fix them. Let's start putting out the fires that we've created. I think the market has more of a reason now to call BS on the Fed, as opposed to, I think, in February when it just seemed unwarranted. It was like where is this sort of coming from? And they ultimately got back in line with the Fed, right? Towards that mid-February when yields dumped. So I think, like you said, it can go either way, but I understand at least now, like where the market is coming from and underpricing the Fed. Because you're right. I mean, Powell can say what he wants. At the end of the day, if the situation gets worse, there's no way that they just turn a blind eye and say inflation, 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 right? So I think, while I don't necessarily agree fully with where the markets are pricing in the terminal rate by the end of the year, I at least understand where it's coming from now, right? And it makes a little bit more sense to me. I guess we'll have to see how that plays out as we get more economic data. And then the next economic data is not for a couple of weeks, at least the important one. So you could see a bit of indecisive action in the markets here as we sort of await that next data point from the markets. But that will be it for us here on Fed Forecast. Let's pass it back to Alejandro.
Beautiful. Thank you, fellas. Let's talk about the system. So yesterday, the 30-minute chart, we got our textbook sell signal. I want to first talk about what happened in the morning because I'm sure there were some people that were caught off sides. I want to talk about how quickly and often sentiment has been shifting in this market. Yesterday at the close, the bears are out. Everybody's going nuts. The FOMC sell-off. Woo. The open, the bulls back parading. Oh, my God, we're ripping higher. Oh, my God, all the bears are trapped. By the end of the close, everybody's bearish again. if you are not trading price action and price action alone and looking for moves intraday that you can capitalize on, you are going to get smoked. There is no other way to put it. If you start to develop a bear thesis, a bull thesis, if you start trying to predict what's going to happen the next day, what's going to happen in the next 2 hours without, developing a thesis based on what the chart is telling you, it's going to be very difficult to trade this market. There's been a lot of volatility as of late. I started the show by saying FOMC did not disappoint. Hopefully things maybe cool off a little bit, but this is honestly a really good trader's market. So if you're able to manage risk, maybe size down, there have been plenty of moves that you could seriously take advantage of. Now let's talk about what the system is telling us currently. So I am still a bit skeptical of this sell-off that we got yesterday into the close for no other reason than the fact that we are exactly where we started yesterday, which was with the break below the 50 SMA on the 30-minute chart. But if you look, we are still at the 50 SMA on the hourly chart, which is in a pretty decent uptrend. So in order for me to confidently say that the Bears have regained control, I would like to see us start to trade and form a downtrend below the 50 SMA on the 1 hour chart. Now, this is just going to be my big picture way of determining trend. Not necessarily going for any big swing trades right now, not looking to catch 50, 100-point moves. I'm still sticking to catching 15, 20-point moves where I can, even 10 points, depending on what I'm anticipating on that day. But it does help me out to understand bigger picture, what's going on. That's how I knew to look for longs when we were trading higher above the 50 SMA on the 30-minute chart. Steady climb higher. We were seeing the same thing on the hourly chart. Now, with the sell signal, we're going to be watching to see if we stay below the 50 SMA, see if bears start to gain control. We are trading lower here in the pre-market, so that's going to be interesting to see where we open. But it is Friday, so trade smart, manage risk, and don't do anything dumb. That's going to do it for the system. I'll pass it over to Ramsay Rippers for Bet the Bell. Do it for the system. I'm going to pass it over now to Ramsay Rippers for Bet the Bell. Good morning.
Good morning, guys. Very pleased about this. I just realized we might need an intern. I completely forgot to update the stats, and this just proves the fact that I am not in cahoots with Diamond, because as of right now, Diamond got a dub on Wednesday. Hondo took a loss, so officially Diamond has 27 wins, and I forgot to update it. So the conspiracy theory among our host, it's not true. It's not true. I apologize, guys. This is updated. Word from wow. A lot is going on right now. All right.
No, it's not up. Oh, it is updated. It is.
Okay. Okay, that's my fault. I thought that Diamond was ahead in the win column, but
that's not updated.
Oh, snipe.
Oh my God.
No, it is updated, brother. You were 14-12 on Wednesday, and
I won. I thought I picked red.
No, you picked green. I remember you took the opposite of
Really?
Diamond and Mander.
Damn.
But it's now completely official, according to how Alejandro likes to judge things. It's now completely official. Like, Diamond is clearly the king as of right now.
Been the king, brother. Been the king.
Well, I don't know that that's true.
All right.
Diamond wasn't supposed to be on the show this morning, and I was mentally preparing. I was like, you cannot brick this green or red. This is your chance. I was hyping myself up, and then I saw him on the show, and I was like, fuck.
It was you had your shot. You still got your shot. We're going to get right into it. As you mentioned, the market is down a tad in the pre-market, not even 1%, down a couple points from yesterday's close, testing and kind of cracking yesterday's low actually as well here. As I said, down about 0.8% of a point of a percentage, excuse me. What do we got today? Green or red, Money Mander?
Doesn't matter pre-market. I was going to take the same answer, whether we were up or down. I'm going to say red today. I think we're starting to see a lot of reversals on the daily charts here and double tops from yesterday. So I'm going to say red, and we finally get some downside.
Hondo.
Yeah, there are definitely a lot of nasty candles after yesterday's close. I'm going to go red.
Diamond, and then we'll go Snipe.
I'm going to go red as well. I think today is one of those days where it can be either way. I don't think that we're going to have like a big red day or a big green day either way, but I do think we'll close red. I think that next week we'll be able to get a little bit more trend, because if you look at it this week, we really haven't gone anywhere.
Sure.
From like the weekly open.
Snipe, here's your shot. Green or red?
Dude, I was going to go with red. I wish everybody didn't pick red right before me.
All right. Pull up the tweet, Ryan. Let's get into question 2 for the guys. Took a look at unusual whales early this morning. Zuckerberg warns in Meta layoffs announcement to prepare for a new economic reality. New economic reality that could last many years. We see this news coming out with TikTok. We've seen Meta just absolutely ripping on artificial intelligence, TikTok news, whatever the case it may be. I mean, I believe Meta's up like 130, 140% since those, was it October? It might have been August lows. Let's see on the daily. I believe it was $88. Excuse me, November. Yeah, 88 to 207, another high of this range that we're moving in. Could this pose some problems for Meta? Can we start seeing like a pullback based off of this news, this new economic reality Zuckerberg is warning of? What's your guys' outlook for Meta? What do we think of this, Money Mander?
I mean, I think this is a problem for every company, not just Meta alone. I think he's really just hinting at the overall U.S. economy here moving forward for the next couple of years, which I don't need to give my opinion on. I think Meta's actually, of a lot of companies, though, poised to do all right because, one, they're trading at a decent PE right now, and two, they've been way ahead of laying people off. They have to have pushing 40, 50,000 layoffs already to try and cut costs. So I think Meta will actually fare relatively well compared to some other names.
Thanks. Hondo.
That headline alone has obviously been bullish. As we've seen layoffs across tech early this year. A lot of those names have rallied on that news. I think it's mandatory, and I don't know, man. It's kind of hard to bet against Meta. People were betting against it. Shout out Jim Cramer when it was trading at $100. I don't know. A lot of these stocks continue to run higher.
Well, that's the reason that I did mention Meta and bring this question to the table this morning. And Mander said something that I think we can all agree with. Just this kind of goes for everyone, not just Meta, as far as the new economic reality. But since we made lows in October and across the board, the little sell that we had in December, as well as the sell that we had from the February highs made to March, where we kind of bottomed out for now at 380. Meta didn't cooperate in that move. They just continued to tread higher. So that's kind of why I wanted to talk about Meta this morning. Diamond, what do you got?
I think that you're getting into a situation like Mander said, where it's not just Meta, but a lot of the large cap tech companies are realizing that with this higher cost of capital, you can't just be hiring people for no reason. I mean, we've all seen the day in the life of Meta product manager where these people literally do nothing. The HR people, same thing. I saw a TikTok the other day of this HR lady who worked at Meta who said that when she got hired, they told her, you're not supposed to hire anybody for a year. Like, you're new at HR, like you're sort of just training. And she was like, okay, well, I'm just not going to hire anybody for a year. And literally her entire group did that, right? Everybody there was new. Everybody had no clue what was going on. They were literally paying people at one point just so that they wouldn't leave and go start their own company, right? I would rather pay somebody really smart and bright $200,000-$300,000 instead of having them leave and go work at Amazon, go work at Apple, go work at a competitor, or go start their own company that could eventually threaten the existence of mine. When money is free, you can do those things. I think that as the cost of capital increases, you're going to see a situation where these people are going to continue to have to lay off workers, not just Meta, but everybody in the tech space. I think that that's going to be good. Not just for those companies to get a little bit leaner, right? You've seen through Elon Musk that you can really operate these massive tech companies with probably half the headcount that you have, right? Half the people there do nothing. So I think you're going to see a lot of these companies get leaner. I think that's going to be beneficial for the ecosystem as a whole. Is engineers sort of leave these jobs and then eventually go start their own businesses or go work on smaller businesses that need the help. I think that ultimately that's going to be a good thing, for the economy in the long run and for Meta in the long run. So I don't think that this is necessarily a bad thing for Meta. Mander said too, I mean, when you look at the valuation relative to some of the other peers in the space, it's pretty attractive. So I like Meta long term.
Gotcha. Interesting point. You mentioned that you saw a TikTok about Meta. That brings to my mind, I kind of understand why they would talk about these future cuts in employees, these employee cuts, because I mean, the only TikToks that I see of Meta are, the 23, 24-year-old girls vlogging their daily life at Meta in Menlo Park, California, Silicon Valley. That's all I really got to say about the Meta TikToks. I haven't seen anything productive on that sense, but gotta love the TikTok Meta vlogs, working for Meta, working for Google, day in the life. Love it.
Yeah.
Those whatsoever.
Those are the people that are getting laid off. Like when they say layoffs to come, like it's not the guy in the back building the algorithm behind Reels. That guy's fine. Like it's everybody else. So
no, it's Shelby, grabbing breakfast at 10:30 with her coworkers and taking a nap in the safe space pod that they have in the lobby. Snipe, what do you got?
I got a couple of things, but Diamond, that was actually insane. That's insane, man. I can't imagine a company just doing absolutely nothing, like having workers doing absolutely nothing like that. Yeah, money's not free, and I think that it is overdue, especially if they do have that going. But one thing about Meta and another company, Google. I'm sure everybody knows about the news about TikTok possibly getting banned, and everybody knows about the hearing. There is that chance that TikTok does get banned. And some of you guys might not know like what the effects will be, but if TikTok gets banned, that's going to be straight ad revenue right to Meta, and that's straight avenue right to Google. Instagram Reels will have much more attention than it ever has, and YouTube Shorts will also have more attention than it's ever had if TikTok does get banned per se. But now, I definitely think that it's crazy to have employees just taking naps and meeting people for breakfast, huge waste of money right there. Just like Diamond was saying, I'd rather pay a intelligent individual $200,000-$300,000 to do something productive. At least I get something beneficial for my company. But yeah, that's just dead weight in a company, and that doesn't really work. So yeah, I think this is overdue.
Right. Thanks for the you make a good point. Also, just on the topic of TikTok, where we can talk about this another time. It's actually very, very interesting if you do take a look, go down the rabbit hole, do some research, listen to the hearings, do some research as far as collusion within foreign governments and TikTok. It's very interesting. I'm excited to see what happens with this ban if it does come in the near future. A lot of heat and turmoil building up on that sense. We're gonna get into our last question, a little bit of an unorthodox question here. I kind of just want to hear from you guys, and if you guys can give a little bit of light to the members. It's not an easy market to trade in. We've seen this. The price action is rough. It's tough to decipher where the market's going to go. It always is, but it just seems even more a little bit as of right now, the first quarter of 2023, even the last quarter of 22. I mean, I hear people talking all the time like there's no point in even looking at the macros. The macros and the market are just completely ambiguous to each other. It's tough out there. So I want to hear how your guys' trading is going, what you think, any updates, any, advice, non-financial advice for the members on, and just anyone watching right here. Mander, what do you got?
Yeah, well, first, I don't know who tried texting you that macros don't matter, but that's a number you should probably block.
That's not what I meant. Hold on a second. You said the same thing too a couple of weeks ago. Like, yields are ripping and the market's not acting accordingly. Like you know what I meant.
The one thing I would say, look, it's a tough market right now for sure. Obviously, as liquidity goes down and volatility increases, you get sharper price movements and kind of out of the blue. You're not riding trend all day long. So it definitely is tough. I think the biggest thing to take away from this is that if you as a trader are, if anything, just going break even and surviving, even if you're not making money, like we're in a bear market. That's really all you can do. 99% of people who are holding longs and not trading are just watching their portfolios go down. So listen, if you're making it through, I think the biggest thing is risk management, right? I wouldn't be sizing, and I'm not sizing the same way I was 2 years ago. and you just take it day by day, right? The whole point is if you make some money on the way down, you're better off than you were, especially the time that the next bull market comes around.
Dwayne.
First off, I'd argue that we are in a bear market. I'd say we are in a sideways doing nothing market. We haven't done nothing has happened in this market for about 6 months now. Yeah, so this month has been good for me. Surprisingly, well, I mean, I don't know why I'm saying surprised, but this has been my best month of the year. But during February, if you would have asked me the same question, very different answer. February was tough. Not as much movement in the market, but bottom line, here's what I would say. Don't get complacent with one I'm finding in this market that something that works on Monday might not work on Wednesday. Literally, you have to be constantly adapting with the market, understanding the bigger picture. If you come into an FOMC week, right, you can't maybe last week, you were trading options and you were swing trading and that was going really well. If you come into an FOMC week, you have to understand the bigger picture, understanding that, okay, I might not be able to do all that. I might have to be more protective of my capital. I might have to be a little bit careful in my trading. Understanding when the market is going to either chop around, trying to get a feel for it, when it's going to chop around, when you're going to get those larger moves is going to help you to manage your risk, whether you want to use a tight stop, a wide stop. It's the market environment that's changing so quickly that is really getting people in trouble. In January, small caps are running like crazy. Now you can't even buy a single small cap. Everything is dumping. So just be adaptive. Don't get down on yourself and try to improve and review your trading every day.
Yeah, I love that. Diamond.
I would say that this market is like Mander said, you're going to get that volatility with just the lack of liquidity that we've seen. And so these rallies are very sharp. They're very aggressive. I think the one thing that has helped me is trading less, because when you get environments like this where you're getting 100-point reversals intraday, you can do more with less, right? So I find myself taking not as many trades, and it hasn't really shown up as a negative in the P&L because we're moving more. My winners are bigger, right? So it's like, I think that you can use that to your benefit in the sense that when people see a lot of range, they want to trade more. It's like, damn, there's a lot of opportunity out there. Let me get a lot of shots on goal because there's so much volatility in the market. If that's your style, great. For me personally, I scaled back the amount of trades because there is so much volatility in the market that I don't need to take as many trades to get to where I want to go. So that would be my one piece of I guess advice: trade less.
And last but not least, Snipe.
Yeah, I agree with Diamond right there completely. Sometimes less equals more. Yesterday I went 2 for 2. Wednesday 3 for 3. 0 for 1 on Tuesday and 1 for 1 on Monday. We're having a pretty nice week so far, but it's all about managing your risk. The less trades you take, the less opportunities you really have to lose. And just like Devin was saying, if you do take these right trades, your wins will be larger. And at the end of the day, if you have a lower quantity of losses and a higher percentage of wins, as far as win percent, like not win percentage, game percentage, then yeah, you'll end up making money and it will cancel out. So I totally agree with that.
Alrighty, good deal. That's going to do it for Bet the Bell today. We'll pass it back to Hondo.
All right. Awesome stuff. That's going to do it for this morning's show. We don't have Moe to go over Mamba market analysis, unfortunately. That's going to wrap up this week and Beat the Bell. Shout out Smooth Brain. Thank you for wishing me a happy birthday.
Yeah, big screen. Before we wrap up here, let's wish a happy birthday to Hondo.
Thank you. And Diamond trades tomorrow. Noah's birthday is tomorrow. How about that? We got
and Mander next Thursday.
Blow out your candles. What's your wish?
We got Mander on Thursday.
That's hilarious. Oh my God. Get that out of there.
All right.
All right. Thank you guys. Appreciate it. All right. We'll see you guys back here on Monday morning, 8:30 a.m. Eastern. Have a great trading day, everybody. We'll catch you. Have a great weekend.